The Success Series. Today, we are going to talk about equity instrument. Equity instrument. Now, what's an equity instrument? Equity instrument is any contract that evidence a residual interest in your assets and deducting all liabilities. What does it imply? It means that for you to get equity instrument, just pick your assets of the entity, subtract all liabilities, and you can see obviously this was obtained from the accounting equation. What is the accounting equation? It states that your asset is equal to your equity plus your liabilities. So for us to get equity, it's going to be your assets minus liability. So in terms of contract terms, for you to also get your equity instrument, just pick all your assets, then less your liabilities. Now, what's the measurement rules governing equity instrument? Now, according to IAS 32, we have two measurement rules. We have the initial measurement and the subsequent measurement. What's the initial measurement? Now, the initial measurement is fair value less transaction cost. Now, what is the fair value? Fair value is the amount you get when you sell the instrument, when you issue the instrument. So the net proceeds that the seller or the issuer will get is your fair value. Now, transaction cost is the incidental cost you incur in the sale. So if you incur any cost to sell, any issue cost, that issue cost or cost to sell is the transaction cost. Then what's the subsequent measurement? Now, subsequent measurement, we say, yeah, you don't remeasure. Why don't we remeasure? We are saying that the issuer here will not benefit from changes in fair value. Bear in mind, if you have sold an equity instrument to a holder, and then there are any changes in the price of the equity instrument, you, the issuer, you won't benefit. But who will benefit is rather the holder. So if you are talking from equity instruments from the issuer's perspective, for the issuer's perspective, the subsequent measurement is that you're not supposed to what? Remeasure. So we don't remeasure. Let's dive into some questions to augment our understanding. Question one. Nova Corp issued 10 million Ghana cedi shares on the Ghana Stock Exchange market, which were fully subscribed for on 1st November 2018. At 31st December 2018, the shares have a market value of 4 Ghana cedi 90 pesos. Required. What amount will be posted into the Nova Corp's financial statement? Let's dive into our solution. But before we dive into that, bear in mind that here the number of shares is what? 10 million Ghana cedi. The price per share is 1 Ghana cedi. And bear in mind that we had a subsequent price of 4 Ghana cedi 90 pesos. Are we going to use that? No, because subsequent measurement say we do what? You don't remeasure. So let's dive into our solution. So yeah, initial measurement to be our fair value. We less the transaction cost. How do we get fair value? Fair value will be what? Price times quantity. It's going to be our price times our quantity. So we'll pick our price per share and then multiply it by the quantity. The price per share was 1 Ghana cedi, and then the quantity of shares was 10 million. So here's going to be 10 million multiplied by 1 Ghana cedi. Then we are going to less our transaction cost. Transaction cost in the question was 0. We're not giving transaction cost. So our initial value will be 10 million. Bear in mind that subsequent measurement, we don't remeasure. So this same value will be our subsequent value as well. So subsequent measurements, we said equity instrument is not remeasured. Hence, the 10 million what is going to be what we're going to remain as our equity instrument in our financial statement. Now let's dive into question 2. On 1st April 2020, Accounting Limited issued 500,000 shares on the Ghana Stock Exchange. The shares cost 2 per share, and then the direct cost of issuing the shares were 100,000. At 31st December 2020, the shares have a market value of 4 Ghana cedi. Required. Account for the above in the financial statement of Accounting Limited. So how are we going to go about it? Same here, we need to take notice of the quantity of shares, which were given as what? 500,000. We need to take notice of the price that we're given. Price was 20 Ghana, 2 cedi, 2 Ghana cedi. And then we're told that direct cost of issuing, that's going to be your transaction cost. So we're giving transaction cost of 100 Ghana cedi. And we're giving subsequent price of 4. By bear in mind, I'm going to use the subsequent price because with equity instrument from the issuer's perspective, you don't remeasure. Now let's dive into our solution. We'll first have to start with the initial measurement. The initial measurement for us to get the initial value is going to be our fair value less the transaction cost. How do we get fair value? Price times quantity. So here we need the quantity of shares, which was 500,000, multiplied by the price per share, which was 2 CD. Then we less our transaction cost of 100,000. Doing this will give us 900,000. So our initial value is going to be 900,000. What about subsequent value? It's still going to be 900,000 because we don't remeasure. Hence, subsequent measurement for the equity instrument will be 900,000, and this was going to be remain the same throughout the value of the instrument.